I've spent this whole season showing you what my trading system can do. Today, I'm going to show you what it can. Out loud, on camera, the honest gap list. Everything a real hedge fund has that I, one person on one desktop, do not. Not because I'm fishing for reassurance, because you can't fix a gap you won't name. I'm Sandbox Theory, solo-built, hedge-fund-style algorithmic trading system, U.S. large-cap equities, paper traded through Alpaca, human confirmation before any live order. 2 episodes ago, I built performance attribution. Last episode, I built the tool that deflates my own excitement. Both were about being honest with the numbers. Today is about being honest with the whole picture. There's a difference between what a real fund has and what a guy in a room has, and pretending otherwise would burn every bit of trust I've tried to earn. So, the gaps, plainly. Then, and this matters just as much, the things I leave out on purpose, which are choices, not gaps. Then the roadmap. Gap 1, and this one I just closed, so let's start with a win. Until recently, I had no performance attribution at all. I could not have told you whether my returns were skill or just a rising market. That's a serious hole, and it was open for most of this build. 2 episodes ago, I filled it, so gap 1 is really a was a gap. Proof this list is meant to shrink. Gap 2, no liquidity or capacity model. Right now, the system assumes it can get the price it sees. At small size on large cap names, that's roughly fine. But a real fund models what happens at scale, because at bigger size, your own trading moves the price against you. You go to buy, and the act of buying pushes the price up before you're filled. The edge you measured on paper quietly decays as the money grows. I don't model that yet, so any result I show you should be read as at modest size, full stop. Gap 3, an operational single point of failure. Let me just say it, this runs on one desktop. That machine has to be on during market hours to place new trades and to manage some exits. If it's off or the internet drops, new decisions don't happen. A real fund has redundant servers, co-location, failover, an ops team. I have a computer and a prayer. But, and this is the important mitigation, so I'm not overstating the risk. The protective stop losses are real, broker-side orders. They live at the broker, not on my machine. So if my computer dies mid-session, the stops that protect existing positions are still sitting there, active, working. The downside protection survives the computer being off. What doesn't survive is placing new trades and managing some exits. That's a real limitation. I just want you to know exactly which parts fail and which parts hold. Gap 4, risk is not an independent function. In a serious fund, the people who take the risk and the people who measure the risk are different people, deliberately, so nobody grades their own homework. In my system, the same code that places the trades also measures the risk. That's a conflict of interest baked into the architecture. It's not that the risk numbers are wrong. It's that there's no independent second set of eyes, and I know that's a weakness. Gap 5, the big one. No multi-year, audited, live track record. Everything I've shown you is paper traded, labeled as such, and even the honest attribution and the honest haircuts are on paper. A real fund has years of real, audited, live returns that a third party has verified. I have none of that yet. That is the difference between a promising build and a proven one, and I'm on the wrong side of it right now. Saying so is the whole point of this channel. Now, I need to draw a hard line here, because people conflate these two lists all the time. Not everything my system lacks is a gap. Some things are missing because I chose to leave them out. Those aren't holes, they're focus. I don't trade options, I don't trade futures, no FX, no crypto, no bonds, and I don't use big leverage. Every one of those is a deliberate exclusion, not a limitation I'm apologizing for. The entire thesis of this project is, can a disciplined process demonstrate real skill at selecting US large cap stocks? That's the question. Bolting on 5 other asset classes and a pile of leverage wouldn't make the system more impressive. It would just blur the one thing I'm actually trying to measure. Leverage especially. It's the easiest way to make a paper curve look exciting and the easiest way to blow up a real account. Staying unlevered keeps me honest about whether the underlying selection is any good, because leverage magnifies everything, including your delusions. So when you see this list, don't read it as, he can't. Read it as, he decided not to on purpose to protect the experiment. So where does this go? The gap list is the roadmap. That's the useful thing about writing it down honestly. It becomes a plan instead of an anxiety. Once done, attribution. The rest are ordered by how much they'd actually change my confidence in a live result. A capacity and liquidity model, so I can tell you not just, does it work, but does it work at size? Hardening the single point of failure so new trade logic isn't hostage to one machine. And the long, slow, unglamorous one that no shortcut fixes. Building toward an actual live track record, honestly, over time, instead of a paper one I can flatter. None of that is fast. A real track record can't be sped up by definition. It's just time and honesty compounding. But I'd rather show you a true short list of weaknesses I'm closing than a glossy demo that hides them. The honest summary, so nobody leaves with the wrong impression. This is a promising, disciplined, solo build with real gaps and no proven live record. It might not beat an index. That remains a completely live possibility. And if the honest tools I built say so, that's what I'll report. Everything is paper traded and labeled. I am not managing your money, and I'm not asking to. If that sober framing makes you trust the project more, not less, good. That was the entire idea of the honesty arc. The whole system is in the repo, linked below, including the parts this episode admits are missing. Issues and pull requests are open. If you can help me close a gap faster, that's the best comment I can get. This wraps the honesty arc. Episodes 11, 12, 13, attribution, self-deception, and the gap list. If those three are your kind of thing, subscribe, because they're the signature of this channel, and the tease. Season 2 is about scaling the book, taking this focused, unlevered, long-only equity engine and asking the bigger questions, adding shorts, going global, and running the whole thing as one unified book instead of a single sleeve. New gaps, new tests, same rule. Paper first, honest always. You can't close a gap you won't name. Now they're all named. See you in Season 2.